Hey, I do not have a goatee. I am shaven clean as of yesterday morning. As everyone kind of gets a notification and trickles in, I'm going to use these couple of seconds to kind of intro and welcome everyone to the show. If you're watching the playback, smash the like button. It helps the algorithm a ton if you'd smash the like button. So please go ahead and do that. Um, Today we're going to be talking about personal finance. We're talking about um, what you'd call, I guess, the financial freedom, financial independence, um, live Q&A movement. So there's this movement, right? Everyone knows about it who follows on my channel that allowed me to retire early. It's this financial independence, retire early movement. And so I want to take this segment or this hour or so that we chat to talk about those sorts of things I haven't talked about before on the stream, like, tax efficiency, like, hey Rob, how you doing? Welcome. Like tax efficiency, like, um, what kind of asset classes you should have your wealth in. What should you be investing in during these times with COVID? How do you build a budget, and how do you save money so that you can actually build wealth? All those types of things that are essential. Topics that, like Mr. My Mustache, or there's tons of other bloggers out there who cover the personal finance space, talk about. So we can talk about all of those things. So feel free to jump in the comments and post any article that you like about personal finance. I'd be happy to comment on it. Any questions you have, etc. and so forth. You want to dig into my, plans, or financial plans, or what I currently do budgeting wise. Feel free to reach out and jump that in the comments. So this might not be the real estate. This might not resonate as well with the real estate folks, but it really should. I know I normally do real estate live streams and we don't go deep on that area, but it's really about what you can save, not necessarily what you can make, right? And so making money is a piece of it, right? There's lots of strategies to make more money, but you have to learn how to save it too and not spend it. So I know it's not as sexy of a topic, but there's lots we can talk about in that area too, right? About how to actually save your money, invest, and build wealth. And by the way, sorry I have bedhead. I literally haven't even didn't brush my hair today. That's the fire lifestyle. Okay, so if anyone has any questions, they can jump them in the bottom. I guess while we wait for people to kind of throw things into the bottom here, Parappa says, hey Mike, can you go over your tenant selection process? So that's a bit of a real estate question, but happy to indulge it nonetheless. Tenant selection. So I don't do a ton of tenant selection anymore. I placed one tenant so far this year, and that was on a personal property that I personally manage, only because I like the upstairs tenant so much I didn't want to give it to a property manager. The rest of our properties are mostly, mostly given out to property management. But this tenant I selected, I can kind of walk you through how I used to select tenants and what I still do to this day to select tenants. So one of the biggest things when you're trying to select a tenant is like loss aversion, I guess, is my first thing that I think of. What is the probability that they're going to damage my unit? And what is the probability, like when they move out, there'll be damages? And what is the probability they're not going to pay rent? And so those are the two things that matter the most. So you want to make sure you find a tenant that is going to pay rent with very high probability, and one that's not going to damage your unit. They're going to keep their unit in great condition. So one of the best ways to handle the first issue is see where the tenant lives now. You can ask to go see their house, and most tenants, well, most of the good tenants are like, yeah, I live at this address, feel free to come by. And a good tenant keeps a clean house all the time. So if you surprise them and said, hey, I'd like to see your house tomorrow at 2 o'clock, would you be okay with me checking out where you currently live? Now, I can't require this, but it's a good idea. You go check out where they currently live. If they're living in a slum hole, that should be a red flag. So go see where they live now, and that'll give you an idea of the true story of what's going on, right? Often when you go to the property, you'll be able to find out if they're a hoarder or if they've got drug issues or whatever. It's hard to hide all that, right? And if someone's willing to go to that length to clean up their house and make it that nice before they're about to move out into yours, hell, props to them, because that likely means they would do the same to you. They would clean up your own house in your own rental unit, right? So that'd be a big one. So I like to see where people live. And that's actually a pro tip. My grandma has had a rental property for like all growing up. I remember her having a rental property. And that was one thing she always did, even back in the 70s and the 80s. And 90s and whatever. I don't know how long she had the rental property for, but since I can never remember, I used to go and like cut her grass sometimes when I go visit her. She doesn't live in the same city, but I would go visit her for the summers, and she'd put me to work. And I remember just like seeing that interaction, seeing that that was how she vetted her tenants, that was the most reliable way. And then she got the landlord's reference. Of course, you talk to the previous landlords. That's one of the best ways to find out how a tenant is going to behave in your unit, because past does tend to predict future. And so that's a big piece of it, right? When you're trying to evaluate a tenant. And I think that relying on the current landlord might not be a good idea. Current landlord might be motivated to get rid of a bad tenant, so they may be incentivized to lie. So maybe not trusting just the reference of the current tenant's landlord. I would say going to previous landlords who have no skin in the game, who have nothing to lose. They would be giving you more of an honest opinion of the tenant. And other things I like to do, you've heard me say, likelihood of paying is based on what a tenant makes, so their income or their sources of income. How reliable are those sources? Will they lose their job? What kind of job do they have? What sort of income do they make? If they don't make good income, can you get a cosigner? Like their parents maybe have great income or lots of assets, and they would co-sign the lease. So those are lots of options to kind of guarantee that payment. I think that, you know, it makes a lot of sense to do a good job screening your tenants' assets too and their spending if you can get a hold of that. A good tenant, and again, you can't require it, but a good tenant would offer up if they have savings. They would say, hey, you know, $10,000 in a savings account, here it is. Or, hey, I have $5,000 in my checking account right now. I can more than afford the rent for the next 6 months. That's a good sign. A tenant who doesn't have that, maybe not as good of a sign unless they have really strong income. And so you have to make the decision with all the available data that you can kind of get to make the best decision you can. And that's all you could do as a landlord is look at the data and say, you know, what can I actually, what can I do here to make the best decision possible? And that's what it's about. It's about, you know, playing the numbers game too, right? Like you've got to get 10 showings out before you find the right one. If you show it to like one person or two people, you have to pick between two tenants. They might both be bad. So you might have to widen your net to find the right, I guess, fish, so to speak. But that would be the way that I would go about placing a unit. So good question. Thank you for providing that question as a filler as we begin to get on there. And for those people just jumping on now onto the stream, welcome to the Mike Rosehart Show. We're live every Wednesday at 7 p.m. With about an hour and 10 minutes or so. I try to keep under an hour, but it just never seems to happen. So maybe eventually we'll get lucky and you know, get in a position where we're able to get it done in under an hour. So someone says they can't. I just saw a question pop up. Not hearing or seeing anything. So I think other people can still see or hear. Smash the like button if you can hear me. That would be a signal right now that I'm actually making contact. I have my laptop here. I wonder if my data is interfering, the fact that I've got a laptop right here. I thought it'd be kind of cool at the end, maybe we would look at, you know, a listing or something like that, or a property, and I don't have a way to screen share that, but I'm seeing all the likes coming in, so I think people are able to hear me and see me, which is cool. Hi Seema, good to see you on. Tommy, good to see you on as well. William, always a pleasure to see you on. He says, hey Mike, my question is, when you first started house hacking, how much did you save off of it? So William, that's a great question. The house hack is a primary staple of reining in your personal spending. So when we're talking about personal finance, people come to me to say, Mike, I'm in debt to my eyeballs. I can't save for the future. I make 50 grand a year. What can I do? And that's usually the first thing that people say when I'm doing like a personal finance coaching call, or if you're sitting down with a financial planner and they're trying to help you eke out some money out of your budget for savings, that's what they're gonna look at. Is like, what are you spending? Your three major categories tend to be your housing, your transportation, and then your variable spending. So like gifts or eating out or going to the bar, all that entertainment, that kind of stuff is typically the three biggest categories you can sort of optimize on. There's lots of ways to optimize in every category. You guys know I rock the public mobile. If you don't already, I'll put the link in the description, but if you want to join public mobile, I love that. I think I pay $32 a month for unlimited international texting. So I often text people in the US, etc. I have unlimited incoming international calls. You can call me from Europe, China, the US, it's free. With my plan, it uses TELUS towers. So in Canada, TELUS has the best coverage. They're better than Bell and Rogers from a pure coverage perspective. So they're owned by TELUS, but I use public mobile. They're online only, they have no call centers, nothing. They're very lean. Every time someone joins and they give a referral code, I get $1 off a month. So that's kind of cool. It's got my bill down to like, I think I'm in the high 20s maybe right now, to like low 30s in that range. And my bill was originally $37 a month. If you pay with a credit card, you get $2 a month off. If you every year you're with them, you get $1 off your plan every single year. Your prices don't go up. So there's just a lot about that carrier as an example that would like save you a ton of money. There's a pro tip about how to save money on your cell phone. I'll give you pro tips on how to save money on groceries. The app, it's called Flip, F-L-I-P-P. When you're walking in the grocery store, you type in lettuce. It shows you every place that lettuce is on sale. Type in eggs, cereal, whatever, juice. Comes right up, you grab that, you price match it. And so that's a great way to save money. You buy the lost leaders from all of the stores and shop at a store that allows price matching. Walmart allows price matching. Superstore allows price matching. No Frills allows price matching. These are just in my local city. There's lots of other places that I'm sure price match. It just saves a lot of time. That's a great way to save your grocery bill. You get that down like in half. Eat the same food for half. Now, house hacking. The original question was, what were the benefits of house hacking, William? And it's my favorite because housing is your #1 largest expense, or it should be. For a lot of people, eating out or going to the bar or entertainment is their largest expense. I've seen people send me their budgets where their rent was $1,200 and their bar budget and entertainment was $1,500. And I was like, geez, how are you spending more at the bar than you are on your housing? That's messed up. Cut that down and get a nice pad, because where you live is where you spend most of your time. I mean, that's the one place I think you should splurge, is probably the place that you live, and live in a place that you enjoy. Things like air conditioning, that's an important feature that I'll always have. A dishwasher, I like that. It's not very frugal, but I enjoy it. There are certain things I like to have. An ensuite washroom is something that I've just liked to have in our last few houses. I've been very blessed to have that, but it's because I designed my house that way. And we talk about house hacking. House hacking is the idea that you can buy a house that is bigger than you might need, or you already own a house that has space that you don't occupy. And if you actually take, and there's an app you can use, I'm trying to remember the name of it, but it tracks your footprints. And you can see where you actually spend time in your house. Most people occupy about 40% of their house. It means 60% of their house goes unoccupied, unused, sometimes for months or years at a time. There's areas of a basement where like just no one goes. You could transform that space into a separate unit and soundproof it, and now it could generate income to cover your mortgage. So your housing expense could be zero, theoretically. You could profit from living wherever you live, in a triplex or a duplex, or take a nice big house like I have and put a basement apartment in, boom, now you have some cash flow coming in to cover your expenses. You can live for free in the house of your dreams. So the idea behind house hacking is that you basically have roommates, or if you don't want to have roommates, you have a family already, you just duplex it, or you have some form of income covering your expenses. I've even heard people call like a solar system on a roof a bit of a house hack, in that it helps cover the mortgage. And okay, I'll allow it. But the idea is that you can get your housing expenses way down by house hacking. People in Toronto do it all the time. They'll rent in the suburbs of like Toronto and suburbs of Vancouver. I've seen people rent the most expensive city in the world, I think, #3 for rent. So you can rent like massive houses, like 5-6 bedroom houses, for like $3,000 a month. You like 5 roommates and then you'd be living for free. So there's lots of ways you could even just rent, even if you're not an owner, and live for free. So the whole house hacking movement is a big one. I've house hacked since I was, I guess, I found a really cheap bedroom in my first place that I lived on my own, and that was like, I paid $299 a month. So it was like a version of house hacking. I just found a really cheap room, and I had a bunch of roommates. But then after that, we got an apartment together, my girlfriend and my wife. We split a 1-bedroom apartment that was $599 a month. We split it in half, so it was like $299 each or something like that. I think it was all inclusive, so that was a pretty good price. And then we bought our first house when I was 19, and we got roommates. And so from then on, we eventually upgraded to a point where we decided we didn't want to have roommates. It didn't make sense. We didn't want to have to share our spaces. And so now we duplex live, or not even legal duplex, but like we have a space that's like almost a dedicated suite that we rent out to help offset that, right? So that's the biggest thing is, when you're looking at trying to design your life in a way that allows you to live it to the max. And I think that, if you had to decide between having a tenant, below you or beside you, or having to go work, I think that for most people, having to go work like 3-4 hours a day, every single day, is much worse than having a tenant beside them. So I think it's the choice. You could choose to have no tenants and have your own house and do your own thing and live it up to the max, have a Tesla or Lamborghini or whatever. You can have it all if you want to, but then you just can't retire early, right? You just won't have any savings left over. So it's a physical choice, and all people fall on the spectrum, the personal finance spectrum, and you can be like totally luxe fire, or even beyond that and have no desire for fire at all and just be wanting to live luxury, and if a downturn comes, you're gonna be screwed because you didn't save for the future. But that's a decision you have to have with yourself and say, hey, like, am I actually happy living with all these luxurious items and tech gadgets and stuff? Or is that actually just like an empty pursuit and I'm actually more fulfilled with time? And I think buying your time is the most valuable thing you can do. So house hacking is great. To, I guess, answer your final question, William, about would it save me? Geez, I don't know. Let's just say like the average person probably spends like $2,000 a month. I'm just making up numbers, but like you could imagine someone in like Toronto or Vancouver spending $2,000 a month on their living costs at least. If you're house hacking, which means like by definition you'd be living for almost free or very close to it, then over like a 10-year period, even $2,000 a month is 24 grand. If you invested 24 grand over a 10-year period, it'd be 240,000 in principal and about 250,000 in interest, depending on the interest rate that you use. We're talking $500,000 over a 10-year period. Over your lifetime, house hacking is millions of dollars in your pocket. For the average person, millions of dollars is a lot of money. And so the choice to live in a duplex could be millions of dollars in retirement. That's a big choice. And so people need to think about, you know, the ramifications of their choices. And most people don't think of the ramifications of their choices. So that's what I'm challenging you to do with the whole house hacking thing. And you know what, like I might get to a point where I don't want to house hack anymore. And that's only coming from a place of my wealth and my passive income has gotten to a point where I can afford to not have to house hack. And that's just because, you know, what I love to do, my passion, makes me money in retirement. And so, and that's not YouTube like you might think. That is a passion of mine, but the passion is real estate investing and locking deals up and things like that. So that's been a thing that's kind of kept me going. And because what I like to do generates some money, I'm like, hell, what do I do with all this, you know, money that I'm making when I don't need it to live? Well, I can just upgrade my lifestyle a little bit, or, you know, save it for the future. Lately, I've just been saving for the future, but I think upgrading the lifestyle is an eventuality. When you get to a point, like imagine with compound interest, money just keeps growing, right? I'm so young, I'm 27. So you can imagine in 10 years from now, my net worth will easily be in the 8 figures. It's a likelihood at the current growth rate that I'm at. And I grow a little bit faster than, you know, the S&P 500 because I invest in real estate and I'm using levered money to grow. But at that point, like imagine someone has $10 million or more. $10 million invested at like 12%, or even $10 million at 12% is, what is that, $100,000 a month? Like if you have $100,000 a month coming in passively without even opening your eyes to do anything, just passively coming in, you might as well, like, what are you doing house hacking in a duplex? You can choose to, you know, live in whatever lifestyle you want. So eventually it gets to a point where it's actually frugal. It's actually still frugal to live in a huge house. And so I get the arguments. I've heard people make those arguments to me about, you know, living in a nicer house and that. And eventually, okay, when it's within your means, and I think within your means probably not getting the house as soon as you might want. Might be holding off a little longer, but the payoff is obviously worth it. So. Okay. Hey Zach, how you doing? William says, so to explain better, it seems like house hacking saved you about $1,000 a month, or $1,000, $2,000 a month. So house hacking saves you 1/3 to 1/2. Thanks. William, I think house hacking, if done well, means you live for free. So your housing cost is 0. So if you were going to be paying, say, like $2,000 a month in rent and $300 in utilities, with a house hack, you pay like close to 0. So you just save all of that. And so we just quantified that. That's millions of dollars between, you know, the age of 18 when you're on your own to like 65. So we're talking a lot of money over the course of a lifetime if you invested that money instead of spending it on housing. And you could live a really good life. You could house hack in a beautiful duplex. Like I'm talking, you could buy a mansion and house hack that out if you really wanted to. And so there'd be no, you know, sacrifice beyond the fact that you may have adjacent units that you could potentially hear if you didn't soundproof properly. And you may run into in the driveway type thing. So I think that sacrifice is definitely worth the money, but that's up to you. It's your choice. Okay, next question. Gail says, hi Mike, how are you and your family doing? How's your spending goal going for this year? Gail, I've just been, so our original goal for this year was to experiment with spending $100,000. What is going on? They're playing out there. She's wanting to come in, so if she comes in, that's life. So my original goal was to spend about $100,000 in, I think it was a year was the goal to spend $100,000. Oh, there goes the door. I'm sure the dog will follow. Or my daughter. Oh, no, she's getting in. Emma, you can't go on. I'm on my live stream, remember? No, you can't go on camera. Mom doesn't want you on camera. No, I can't go up and push you on the swing when I'm on my live stream. Oh, no. I gotta block it. I gotta block it, guys. promised my wife I would not put her on YouTube, and looks like she's determined. My daughter is the most determined, strong-willed person. She will always do what she can to get what she wants, and so that means that I gotta end this stream a little early and go out and push her on the swing, because she needs to. She was good. She left there and she didn't throw a fit, so I got to reward her for that good behavior. But Gail, the question you were asking about, what was it? Oh, my spending. So I wanted to prove that spending $100,000 a year didn't make you any happier, and so I was eating out like crazy and just like trying to spend more. And can admit it made me no happier. With COVID, we kind of couldn't spend because there's nowhere to go spend your money. So I've just been like saving like a fiend through COVID. But yeah, COVID-19 kind of threw a wrench in that plan. So I don't think I'm gonna reach the 100,000 spend for this year. It's just not gonna happen. But in the months that I was doing it, I can tell you I was no happier. I think I felt better being frugal. Only seeing my net worth grow and seeing my bank balances grow, it releases positive endorphins. Just like logging on my app, they've shown that like looking at your investment account gives you positive endorphins in the same way that looking at like a credit card bill or like watching your money go down actually releases some negative feelings and endorphins, right? So that's something to think about, I think, when you're deciding what you want to do with your life, whether you want to live frugally or not. It's up to each person. Mr. Mikel says, hi, Mike. Hello, how are you? Where is this going? I was planning to fire by the end of this year, but part of that involves selling my business. Not really a good idea at the moment. Yeah, good question. Where is this going with COVID-19 and this whole coronavirus thing? I think that we're in a recession. Like, by definition, we're almost in a depression. Now, that's artificial because the sudden stop of the economy forced this to happen. But I will say, I think long-term we're going to be fine. I think that you could still find a buyer for your business. It's not unreasonable to expect that you could find a buyer for your business, and you might get a little bit of a discount, but you could still retire. Like, if anything, you could decide that, hey, stocks might be on sale this fall. The whole market might be on sale this fall. When you factor in the expense of, okay, so think about this. If the market's down, say 30% this fall from where it was, once we see the quarter earnings coming in, I think there's gonna be a bit of a dip. And if there is this dip, then you can imagine even further than there already is, that there could be a 30% sale on stocks. If you could sell your business for even 20% less than you were expecting, say like $2 million for your business, and now you're willing to take 1.6 or 1.5 because it's COVID. 1.5 invested in the stocks in 2-3 years is the same as if you just held your business, right? Because it's gonna get 30% appreciation when the market rebounds. So that's something to think about too, is cash is king during these times, and liquidity is everything. So that's why I sold off a couple properties this year. Yeah, so I'm getting liquid. I'm building a war chest, and that's just my personal plan, so I can invest in a more diversified asset class. I think that real estate's great, but I want to see, you guys know I have the 4 buckets. I think that like having a really diverse stock portfolio or equities portfolio is important. Owning a piece of small businesses is great too, that you can control. Real estate, and then I think lending is another good piece of a diversified passive income strategy, right? Relying just on real estate, that's high risk. Relying just on stocks, again, I think that's high risk. If the market goes into recession, you want to have multiple avenues or multiple streams of income, and then within each one, like you want to have like 10 rental properties, not one. Because if a tenant leaves, like you're screwed. But if you have 10 properties with like, they're all duplexes, you have 20 units. So if you have a unit or 2 empty, it's okay. You can carry it with the other units. Same is true, for all the things, the lending, etc. You want to have multiple buckets and multiple streams of income to reduce risk. Diversification reduces risk, and so that's a big piece. There's strength in numbers, as they say. Mr. Frugal says, hey Mike, what are your thoughts on the fractional ownership applied to real estate? Now, anyone can buy and sell shares of property through online platforms such as Realty. Now, this is a US thing. I don't think that the crowdsourced, buying and selling of real estate, or like, I guess, owning fractal pieces of real estate is possible in, say, Canada. If that was I would love to start that. I would be behind putting that together. So someone reach out to me if you're watching that and you want to put that together and you have that set of skills. I'd be happy to get behind something like that. I think that's a great idea in Canada in general. A lot of people don't want to invest in a large REIT that has a lot of commercial holdings, and a lot of people don't want to, I just think that for the person who doesn't want to own a rental property, it's a great option to invest in real estate. So I'm a fan of it. I would be very careful of which properties. I don't know if you can, I've never even been on the website to look into it, but if you get granular enough that you could pick the properties that you had fractal ownerships in, that would be cool. Like you could pick the cash flowing properties in the cities that you, in the neighborhoods that you wanted within that city. That would be cool. I'd be interested in actually just having an experiment with that. I would throw 100 grand towards that just for the fun of the experiment. So someone follow up with me on that if you know more about that, but that's great for bringing that up. Thank you. I think that was a great idea overall. I think that, you know, despite what the real estate market might do, long term, if you're getting cash flow from that fractal ownership, and it's not about the appreciation, but it's about the cash flow, then I feel really good about that. If you're levered up, and I don't know how they do it, I don't know if they're like 70% debt. If it's 100% just like cash from investors, the return would be bad. So I would think that it wouldn't be good, because you're buying real estate in cash, you get like an 8% return on your cash. So you want to lever up. You actually want to go get a mortgage 80% loan to value, because your return on your invested capital goes way up. So that would be my only worry. Same issue with REITs. REITs often can't lever up as much as they'd like. They need a lot of investor capital. The banks won't look like 60%, 70% loan to value. There's a lot of capital tied up in the properties. That's why REITs don't perform as well as owning rental properties on your own. Just quick thought in my head. Jason says, hey Mike, do you have any turnkey rented properties you're looking to unload? Yes, I do, Jason. I have a couple that I would be willing to unload, or that I know of, people who want to unload in the London area. So reach out to me on Instagram. I'm worried this trend will create volatility in the markets just like it does with stocks. So I don't know. I think real estate is less, in general, people are less flighty or panicky with real estate because they have the cash flow from the rents. They can just hold, right? Like they can get like an 8 or 10% return on their money. Why would they sell? But you're right. It is possible that crowdfunding real estate could, you know, when investors own tiny pieces and it's easy to become liquid, if you can find a buyer for it like that, then yeah, it's an interesting thought. You think that the market irrationality would then apply to real estate. It often didn't, because real estate was so illiquid. It takes a long time to sell a house. It takes time to go into like escrow. It's like 60-day closing. When you make a decision to sell a house, you're months and months from getting cash, right? Same is true if you're buying a house. It takes months often to get the transaction done. And so that's why real estate doesn't tend to react as irrationally as the stock market, because when you can sell a stock like that on an emotional decision, it's hard to take that back. But with real estate, you know, listing your property, you have days and days and days to cool off and to think about the decision to sell, and et cetera and so forth. You can walk away at so many exit points. You can walk away and say, no, I don't want to sell the property. I changed my mind. I'm going to keep it. I'm going to refinance it, whatever. So people aren't as irrational as they are with stock selling, right? Like now we have bots that stop losses, auto selling. And so like, as soon as someone starts like irrationally selling, it creates a cascade where like, boom, boom, all of a sudden, like a bunch of bots will get in there and we'll have a stock drop like 10%. The volatility is crazy right now because it's not a whole bunch of institutional investors like it used to be. There's a lot less of that in the stock market. So that's what we have to be careful of, is that market irrationality. The market psychology is the problem. It's why I recommend diversity, and I recommend a long-term approach to investing, because we can't predict what is going to happen in the short term. None of us can. And we also can't predict exactly how humans will react. And we know that human psychology is mental. Like we make stupid decisions like when we have the chance in a short period of order. Like fear, for instance, motivates people to do stupid stuff. And they admittedly make decisions they wouldn't have made if you run through the simulation when they're not stressed, right? So we know that like fire sale of stock during, you know, anytime there's a fear or any time of, I guess, downturn, it just perpetuates, where it doesn't do that in real estate in the same way. So that's all. Okay, next question. Vendor buyback preferred. So yeah, I don't really have anything that's vendor take back. That's where like the vendor would finance the deal. And so I'm not for the rates that you'd be able to afford probably. John Rafael Andel. Hello. Next question. Other question is, how much should it cost to change out all the breakers in a panel? I thought the price might be a few $100s a panel, or I think you mean per breaker. Got quoted for $1,700 for 2 panels. Seems way too high. It depends on so many factors, the type of panel that you have. Certain panels have cheaper individual breakers. It depends on the types of breakers. Like bedrooms, for instance, need to be arc fault protected, whereas like a random hall plug might not need to be. I don't know the current ESA code, but here Electrical Safety Authority requires that all bedrooms are like arc fault protected. And certain panels, the arc fault breakers are really expensive. They're like $80 a breaker. And then on like other panels, sometimes it's like $5-10 for, you know, a non-arc fault protected breaker in the circuit. So I would say the answer is this: bring in 3 independent electricians for quotes, and if all 3 quotes come back $1,700 or in that range, that's probably what it would cost to do the work. Now, if it comes back $1,300, $1,800, and $2,600, now you know the price range, right, of what it costs to do the job. So what I've always done, and when I was learning, I didn't know the price of something, I would just bring in multiple people to give me a quote, and then I would know exactly what the market price is to do that work. And so that's an important piece, I think, to pricing out any renovation or anything in general. Just getting lots of quotes is smart. It wastes time, but it is a way to become knowledgeable. And then eventually, when you have that knowledge, you can say, hey, you know, to swap out all the breakers in a panel should be like $1,000 or something, right? I guess if I had a cheap electrician, it'd probably be, I would guess, in that range, but I don't know the scope of work. It's hard without seeing it to quote anything, right? It seems like it's in line for 2 panels, but I don't know the extent of it. I don't know, like, if you have a lot of stoves, or I don't know what kind of stuff you have going on in your panel, right? Greetings from the Caribbean. Warm people, warm weather, but no hot bubbles in stocks and bonds or in real estate. Greetings. Hey, Andrew. Is this London, Ontario? Yes, it is London, Ontario. Canada. Smash the like button. Sound is good. Live chat content. What's up? Hey, Don. Good to see you on. Jason, good to see you on. George, good to see you on. D How To says, yes, we can hear and see you. Cool. Appreciate the thumbs up, guys. 21 likes. Appreciate that. Hey, Mike, I have 2 properties in a small town. They're both 1% rural, but have not and likely will not appreciate very much. My question is, how do I continue to get financing in this situation? So the question was about, so investing in small towns in general can be a little bit more difficult because lenders are, there's a higher risk at the smaller the town, right? There's no guarantee it'll be there long term. It tends to have less of a diverse economy, et cetera, so forth. So lenders tend to be more conservative, but at the same rate, because there isn't a ton of investor capital in a small town, you'll get better cash flow to the price. People will discount the cash flow more, and so therefore you'll get more bang for your buck. So the question is, they're both 1% rule, but have not and likely will not appreciate very much. So the reason for that is because appreciation is driven by an increased, well, it's driven by a lot of things, but one of the main contributors for appreciation is the increased demand for housing compared to supply. And if you're in a small town that the population isn't growing, there's no increased demand, and there's no investors, say, coming to this small town because why would they, when they can invest in a larger market that's growing? And if the market's not growing, if the population, some of these small towns have populations that are shrinking. So real estate is actually becoming less and less valuable in those places, or at least the land isn't changing in value, probably. It's probably just like appreciating a little bit, but the building is depreciating in value. And so that's, after 5 years, you have a 5-year-old building, it's depreciated another 5 or 10%. And so that's eating away. In a market like Toronto or London, where I live, the land is appreciating so fast that it appreciates faster than the depreciation on the building. And so that's something to think about too. When you're investing, is small towns sometimes don't appreciate, and that's just a fact of life because of demographic trends, because of the 4 things I talked about 2 streams ago, when you're trying to evaluate how a real estate market is going to perform. And so for myself personally, I like to invest in markets that have good cash flow and good appreciation. So I buy 1% rural properties in areas that have good appreciation prospect, in places I think that are going to be more valuable later on. I want to own land that's desirable. It's the same reason, like, you go buy a property 2 hours outside of Toronto, or like in the worst area of Toronto, it might cash flow better because it's trading at a discount, but you're in the hood and you get shot going to your rental property to like fix something, right? At the same time, Scarborough, no, I'm just kidding. At the same time, you could buy in like the core, like right in the best area of Toronto, and it's going to cost you a lot, and you're going to have very little cash flow, but it's a strongly desirable area. And in times of recession, it's very, everyone wants that piece of land. And the first rule of real estate investing is location, 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 right? So I've always been a location guy first. That's why I tended to not even invest in like East London that much in the beginning of my investing journey. I felt much better about investing in the prime areas, the good areas that are going to be always desirable long term. And so there is something to be said about owning good dirt, And I guess owning property in a small town isn't necessarily good dirt, but it could be. I don't know. If you live in that small town, you like that small town, and you feel good about it long term, then there's nothing wrong with investing there if there is an appreciation. Just factor in, hey, I'm not getting appreciation anymore. And by the way, like, let's even a 3% appreciation per year in a city like London, that's like a conservative benchmark. If you're levered, which means you have 20% down and you're 80% mortgage, so you put 20% down on the property, every dollar you invest, if it appreciates 3%, it's a 15% or 5-to-1 growth. So your down payment, every 3% of appreciation, your down payment goes up 15% return on that down payment every single year. So if you have 10% appreciation in a market, our down payments get 40 to 50% growth. So if your market goes up 20% in appreciation over a 5-year period, right? So divide that out, that's 4% a year. 20% appreciation is the same as doubling your down payment. So you can double your money in 5 years with a 4 or 5% appreciation rate. So appreciation is very powerful when levered, especially when you have cash flow to cover that. So good questions related to that. I guess my point is, if you're making money and you're happy with that, and it's the best type of cash flow you can get for that city, and you want to invest in that small municipality or city or town, go for it. There's nothing necessarily wrong with that, but just know that, like, you might not be getting the best overall return as you could. And so that's why when people reach out to me and say, like, hey, I'm getting 2% rule in my small town, I'm like, okay, I'm still interested in going to that small town because, well, one, I know London and I know the market well here and I have a competitive advantage here. But two, you're losing a lot of appreciation piece too. So something to think about and factor into your decision. So how do you continue to get financing? Devin, the other thing is, we're talking about burring. You can burr real estate with no appreciation. You could buy a property in a flat market that's $100,000, add $50,000 to it, and it's worth $200,000 after, without any appreciation at all. You just created $50,000 in equity because you've added value and changed the comps. You've changed so that now it comps out against different properties. So you can pull out or make money in real estate in any market, and that's the beautiful thing about it. Especially a market that cash flows, you're actually blessed. Better to be a small town than somewhere like LA where there's no cash flow. So something to think about, I guess, or like Vancouver as another example with very little cash flow. There are exceptions to the rule, but on average. And so you're blessed, I guess, in that sense. And so as far as financing, you can keep buying. If you have good cash flow, you should really go back to the bank and say, or find the right lender and say, look, my properties are cash flowing. I'm making a lot of money from them. I want to buy more. And you can pull, as you pay down the mortgage, you'll still build equity that way. If you renovate the property, you can add value through renovation. That's a big piece too. You could do a $100,000 renovation for 50 grand. And I just added 50 grand in value. You might have to manage it yourself. You might have to put time in and sweat equity, but you could build wealth that way to get money out, refinance it, and then buy more properties. Or you could just save the extra cash flow you're getting now because you're in an area that cash flows really well, you're saying, and just save that, and then you'll have a down payment to buy another property. Use the cash flow from the rentals to buy more rentals. And as you buy more, it'll snowball. So it kind of works no matter what, no matter where you are. I guess no appreciation isn't ideal, but it's still manageable. We may go through a year or two of no appreciation here in London, and that's okay to have a couple years of no appreciation. I'll still make a lot of money in real estate. We all still can make a lot of money in real estate. So yeah, good questions all around. Hey, how you doing? Good to see you. Same to you as well. Thank you for the thumbs up. What are the most likely uses for empty commercial properties following COVID-19? Any significant impact on the residential rental market? So, Mr. Frugal, I would say it depends on the area, it depends on how the property's outfitted, but I'm assuming that a bunch of commercial real estate is going to be converted to residential real estate. That would be the most logical solution, but I could see them. There's a trend for people buying too much stuff and needing a place to store it. So I can see some commercial properties becoming storage facilities. But yeah, I think residential is the way to go. You take a property and you might already have a washroom, but you just have to add a shower to it and put it in a kitchen. Or you might already have a kitchen, you just have to put a stove in, and now it's a residential unit. So I can see commercial places retrofitting and renovating to a point where they're retrofit micro units. You have 20 or 30 micro units. So I'm a big fan of micro units, and I think that that's a way that it's going to go. Or they're going to take these commercial buildings and make them like into little Airbnb units, in which case they're like a hotel. So I could see there being a demand for that, and then they could even target longer term stays, but as a hotel or a motel, right? That kind of thing. So I see a lot of conversions going that way because there is a demand there's a huge demand for places for people to live. There's in fact a housing shortage, even still, even with the immigration being all-time low because of COVID-19 and kind of at a halt, there is still a ton of pent-up demand and need that exists, and so it should help satisfy some of that. I know a guy who would surprise his potential tenants by visiting their current place without advising them. There you go. That's one way to do it. You could go check their address and see if they actually live where they say they live, because people lie all the time. Matt says, hey dude, nice to chime in again. Good to see you on. Welcome to the stream. Appreciate the sub. How did you educate yourself on home renovations? I suppose Google, YouTube, but primarily I learned through doing. Like I would hire someone and work alongside them and ask them questions as they did it. So I'd hire a plumber, hire a framer, didn't know how to frame at all. And like through that process, I probably spent at least $100,000 more than I needed to spend doing renovations across like, say a dozen properties. And that's because I was learning. And so I would get a bad plumber who'd make a mistake, and then I had to fire him and get another plumber in to show me what they did wrong and then pay them to fix it. So there was a lot of that going on where I was learning the trades by physically being on site and managing. So I didn't just pay a guy and then leave. I stayed on site and I learned. I had to grind it out. And that's the only way I think to learn construction, is to put the hours in. That's the best way to learn construction, is physically doing and being there. And your time there should be adding value. And so that's a big piece of it. Next question. Why would you threaten to evict people during a pandemic? Makes no sense. You catch more flies with honey than you do with vinegar. I agree. Totally agree with that. During this time, it's very, very hard to evict anyway. So it makes way more sense to work with a tenant and try to find a solution. At the same time, like there's a lot of tenants out there who expect handouts, and like I've heard stories of, and I don't deal a lot with tenants, but I've heard stories of people reaching out and saying like their tenants demanded 50% off their rent, and like they just demanded that. Like what? Often landlords don't even get rent deferrals on some of their rental properties. Often there's nothing for the landlord to reduce their expenses, and people sometimes think that like rent is pure profit, but on average, if you look at the data, between 5 and 20% of rent is net profit. So if you offer 10% discount to a tenant on rent, oftentimes that's your entire profit margin for the whole year. So you'd be at a break even. Anything less is asking you to pay their rent for them, which is like, they might as well be beggars. They might as well be going out on the street and saying, hey, can you pay my rent for me? That's crazy. So I don't know, I'm of two minds on that. Having been a tenant and grew up in that environment, I can see where like trying to get a discount it never hurts to ask, I guess. But I agree, it makes more sense to try to offer honey than vinegar for sure. The best thing to do is to screen ahead of time and inherit no tenants. If you can avoid taking new tenants, when you buy a property, if you can get it vacant, that's the ideal. And then you place your own tenants in. Don't trust it to a manager unless you really trust that manager, but you put your own tenants in. And when your own tenants are selected there and you've done the due diligence, when I've done the due diligence and I've seen where they live and I followed all the steps I talked about checking their savings and checking what they make for income and verifying all that stuff, my tenants don't default on rent. Even during COVID, they pay their bills, because most of my tenants I've placed have $10,000 or $20,000 in savings. They can afford a year's rent without a job. That's a good tenant, and good tenants pay their rent. Bad tenants don't pay their rent. Tenants who've gone through hard times, they don't pay their rent because they didn't have the savings for the future. A good tenant is ready for a recession, right? They're planning for it. That's a good tenant. And so as a landlord, try to find those tenants if you can. That's why it's so important to screen. Okay, so heads up for those in Ottawa and Quebec. Fizz Mobile is really good. I pay 38 taxes in with 6 gigabytes unlimited. Everything unused data rolls over. That's cool. I'm not in Quebec, but check that one out. It sounds like a really great cell phone carrier. Finally, we have some good options in Canada. I got a question. What would you do if you got $20,000 and you're new to Canada? And will you start with real estate? So, Mr. McCall, $20,000 doesn't get you very far in real estate these days in most cities in Canada. You can't really buy a property at $20,000. You could spend 20 grand to build a wholesaling business or to invest and get a real estate license. Wholesaling and real estate license is the same thing, effectively. One's just like regulated and licensed, the other one's just fly by night. But yeah, there's lots of ways to invest in real estate, I guess, without buying real estate. But 20 grand doesn't go very far, and most people aren't gonna wholesale. The average wholesaler makes less than the average realtor. You gotta think that most people don't make a lot of money wholesaling. It sounds like this sexy thing, but it's a really hard sales job. where you have to connect, well, first you have to find properties under market value, not just properties off market, but properties off market under value. And then you have to find an investor who sees the value in that and then pays you a fee for that, right? So it's a hard thing to do to wholesale well. And so I think a lot of noobs get into wholesaling and then I see them leave. And I hear messages when they try wholesaling and they fail, or they do one wholesale deal and then that's it. It's all they could find for like 6 months. And so they make less than they would have made just working full time. So something to think about, I guess, if we're gonna get into that industry. Having, been involved in it for a while, I can kind of tell you, it's a tough one. But yeah, buying property at $20,000, you'd have to probably partner up with someone to really, or like buy a really cheap property. That'd be the only way that you could get $20,000 and invest. I guess if you're new to the country too, you're a new resident, so it'd be hard for the bank to want to lend you money by yourself for a mortgage. You'd probably need a joint venture partner. I guess the easiest way to invest in real estate is just go buy into a real estate investment trust or do some private lending. That's an easy way to get your money invested into real estate without actually buying a property. You can buy into a fund that buys property. Next question. And by the way, for the 59 people that were just on here, 64 that were just on here, now 52, I appreciate y'all watching. Thank you so much for giving me your attention span every single week. I will be spinning up a website pretty soon where I'll be putting on some of the old content I had up and some of the free tools to download. So stay tuned for that and smash the like button for that as well. So that's coming when I get some time to do that, or I guess the willpower to do it. And next question. Hey, Brian. So Matt says, officially moving back to London in a couple of months and start the house hunting. We'll have to link up once I'm back. Yeah, Matt, I'd be happy to, if you need a realtor, I'd be happy to make that recommendation or referral for you. I'll have to link up. You mentioned buying in London around $200,000 and putting $20,000 into renos. Do you still have numbers that would make sense like that today? $20,000 seems very low, especially if turning a basement into rooms. So Matt, if you did a lot of the renovation work yourself and you hired cheap sub-trades for $20 an hour and worked with them and you fed them materials and you kind of did a lot of the heavy lifting for them and kept them focused on a task, and you brought each specialized trade in, one to frame, one to drywall, etc., you'd be surprised how far $20,000 will go. Especially if you buy a property with, say, an old bathroom in it already, you just have to remodel a basement. For $20,000, you can remodel a finished basement into a full apartment pretty easily. So it depends on your budget. It depends on how nice you want to go, I guess, with the apartment. But it's totally possible to, $20,000 goes pretty far depending on what you're trying to do. So yeah, it's totally possible to buy a house for $200,000. Yeah, if you want to live in East London or you're willing to kind of, East London's not the worst. There are pockets that are decent. So you pick a decent pocket in East London and there are houses I see go up for $185,000, stuff like that, 2-bedroom houses or small 3-bedroom houses, tiny ones that you could, you could make it work, get a couple of roommates and you could own a house for again, $30,000, $40,000 in. Maybe you can refinance some of that out when ARV is at $250,000. So yeah, there's totally options where you could do that. If you want something decent in a decent area, you're gonna have to pay high 2s, early 3s, I think, to get anything decent. But there is stuff small houses that you could live in and make it work. Brent says, Mike, you can afford to have air conditioning and dishwasher, etc., but most people in the world cannot, or only with debt. You have to distinguish millionaires from everyone else. Brent, good point. I will say this. I will say that if you lived in a developed nation like Canada or the United States or etc. and so forth, you can afford to have those things. It doesn't take much more to find a rental that has AC versus a rental that doesn't. In fact, the rent difference between a unit for rent with a dishwasher and AC and one that doesn't is 20, 30, 40, 50 bucks a month max. $50 a month difference. So we're not talking a lot of money to have those modern luxuries. But you're right. In general, being someone who lives in, say, the United States or Canada or Australia or New Zealand or Europe and a whole bunch of great places around the world to live, we're blessed. We're the top half of the world, and there are people in Africa starving. I've been to Africa. I know. I worked there and did a human rights mission, and so I can attest to just how tough it is for some people out there, and we are blessed. And so we should be thankful that we're blessed and not squander that blessing by blowing it on consumeristic crap we don't need and actually living a good quality life. And then give back if we can too. That's important. Gotta give back, guys. If not just with your time, with your money too. I lost my place now. Oh, found it. D-How2 says, so those are good tips. The last time I was in Toronto, I had no cell phone service, only had internet service at the Airbnb house we stayed at. I was totally dependent on friends for Uber rides. I appreciate that. That's a good tip. And that sucks about the not having cell phone service. Brent says, so with COVID-19 economic depression, what is happening with the housing market and home prices in Ontario and elsewhere in Canada? What is happening right now? We're actually seeing a bit of now they're opening things back up. There's a bit of a hurrah, a bit of a bump up. I think that's just pent up demand that was scared to make a decision during COVID. That is gonna like waste away quick, I think, with people who need to sell. And so I think we're gonna have a summer here in my area in southwestern Ontario that is a lot like the spring we normally have. It's gonna be hot as hell. And so we're gonna see a bit of an uptick, but then I think in the fall it's gonna be a bit of a crash, to be honest. I think we'll see houses start going for 5 to 10% discounts. We'll see a little bit of a drop. The data, if you look, I did 3 streams ago, I think I talked about like a real estate crash into 4 indicators. We're seeing that we've lost 1 year's appreciation in London. It's gone. We're 1% higher than we were in April 2019. So average price is up 1% in a 13-month period. We were up 10%. So we've just seen basically a drop of almost 10% from the peaks we were seeing in February. So the data suggests that we are down. And I think we're gonna have a resurgence. I heard of some listings going $100,000 over asking. So some stuff's getting crazy with all the heat and the lack of available inventory. A lot of people don't want to sell their house right now. So there's a bit of a shortage. And now the investors are taking advantage of the cheap interest rates. So something to think about. Are you able to house hack with COVID-19 pandemic? Temp moved out because of this. Yeah, I mean, it could affect your house hacking during this time. It's possible. You could always have a unit that has a separate heating system, so you're not sharing any air. It can be totally safe. You don't have to interact in any physical way. So you could house hack if you had a separate heating system. Like, imagine that you didn't have a cold air return in that unit and you just had like electric baseboard heating or a separate fireplace, that sort of thing. My basement has a separate heating source, so I'm able to kind of do that if I want to. But yeah. Saving for the kids or for more real estate, maybe next year for your goal. Yeah, Gail, you never know. I'm not closed off to the idea of having more kids or buying more real estate. Next question is, hi, first starting off, you buy single family or multifamily dual occupancy or convert? So it depends on your strategy. There's no one right way. It says, okay, so sorry, let me rephrase. When you first started in property investing, did you start off with single family house or duplex or triplex or fourplex for that positive cash flow? Thanks, Mike. Okay, so I guess now that I clarified that, I'm gonna give a different answer that I was going to give. I think that, so I started investing in duplexes. I loved buying single families that can convert to duplexes. My first 2 rental properties were double unit, so there was 2 units in it. And I focused on student rental for my first one. My first property was when I lived in. My second property was my first student rental. My third property was just a duplex that I bought. It was a family rental duplex. It could have went to students. It was in an area that was borderline on the student canvas, but it didn't have students in it. I didn't actually rent it to students. I rented it to family. I put seniors in, actually, in one case, because the main floor was really nice. In the basement, I wasn't students, but young professionals in. So I think that, yeah, it depends on your area, how you can sort of find an arbitrage angle. And for me, duplexes were that angle. In my market, they were selling cheaper and they were providing good cash flow. Or if I could buy properties and convert them from single family to duplex, that was the bread and butter. I was just afraid to get into the triplexes and fourplexes that I saw, because one, they seemed to be pretty overpriced, and I was competing with like more aggressive, smarter investors. And 2, it was just, for me to get started in real estate, I was afraid to buy a property with 4 tenants in it, and like not even 4 tenants, often had like 3 tenants in each of the 4 units. There'd be like 10 people living in this building, and a fourplex kind of scared me. So I started small. I started with a duplex because it was more manageable for me. And that was just me, because I was managing my own stuff. So to each their own, depends on your circumstances, but there's no wrong way to invest in real estate, unless of course you're investing for no cash flow, in which case you might be investing in the wrong way in real estate. Next question. Will the market crash soon like it did in 2008 to the point where I can get a huge return? I don't think so. I don't think it'll be like 2008 at all. Maybe It might be like 2008 was in Canada, because in Canada we were largely unaffected. In London, we barely had a dip at all in 2008, 2009. So in my market, I wasn't largely affected in Canada here in London. So it depends on the market. I think it might perform like 2008 in some markets. But no, there's a different set of market conditions that isn't going to be the same. We don't have the same mortgage issues. Real estate isn't as drastically affected as 2008 was affecting real estate. That said, I think a 10% drop in real estate prices is possible, probable, maybe even likely. Next one is, P.S. Following on previous question, did you have to do any conversion to multi-occupancy when you first started? Thanks. Yes, I did. Didn't have to, but I did choose to do that. Message retracted, can't see that one. Thank you for leaving a message anyway, Sarah. Thoughts on knob and tube wiring? About a fourplex and half the units of knob and tube. Make sure you at least get the circuits GFCI protected at a minimum with the GFCI breakers. That's a minimum that passes code with knob and tube, but it is the connections that are the highest risk, right? So I would probably get it changed. I have a 3-bed that's vacant. What can I do to get higher rents? You could put in laundry, you could put in a dishwasher, you could add certain amenities like parking that it might not have now. You could just overall renovate the unit to make it nicer, and that would get your rents up. But yeah, I find really good return on investment by putting in laundry and putting in unit dishwashers. Things like that go a long way. If there's like a giant dining room, you could close it off and make it into a bedroom and make it into a 2-bedroom or make it into a 4-bedroom unit and maybe get more rent. So it just depends on the unit. I have to see it. What's the biggest loss and the worst encounter you dealt with in your housing ventures of house hacking? So I've had some tenants damage stuff and leave things pretty gnarly. And so I've been through, a few $1,000s in damage having someone move out. So that's a possibility. You can go through that. But I've been mostly blessed overall. I've had some bad tenant experiences, of course. I've had some like horror stories when it comes to tenants, but overall I feel pretty good about, my whole overall journey. Do you buy supplies secondhand from the restore? What's your biggest bang for your buck? So Matt, I used to go to the restore and try to like pinch pennies, I guess, where I could, and I'd go to Rona and get like drywall on super sale for $5 and get it delivered, and I would just go all over the stores shopping the sales. I do less of that now. I used to make like 90 to $100 an hour fighting for the prices that I wanted at the different stores, and so I would say it depends on what your goals are and what your time is worth. If your time's for $20 an hour, it's worth it to do it if you don't hate it completely. But now I actually get like anxiety going into a Home Depot or a Lowe's or a Rona. It's ruined for me. I spent so many hours helping all of the investors that I used to work with renovate their properties that I lived at Rona, Home Depot, Lowe's, Home Hardware. Like I lived there. I was there every day, all the time, for hours and hours and hours, fighting with these incompetent, dumb staff that had no idea what they were doing for the most part, made tons of mistakes that would end up costing me so much money. It was just frustrating. I was tired of it. And that's because I did it on a big scale. I took on so many renovations at one time that I just burned myself out to the allure of renovating. I hate it now for the most part. I like the design aspect still, but it kind of burned me out doing so many deals, and just a personal preference. But yeah, the restore can be good. Just be careful. Some stuff's just junk there. So you have to be careful what you're buying, but there are diamonds in the rough. There are gems hidden at the restore you can buy for a great price. So yeah. Are power of sale or bank-owned properties good to buy? Levar, it depends on a lot of factors. Sometimes they get trashed and they're left with, or the person walked away because they had a major structural issue. You don't know why they're, bank-owned. What happened. Oftentimes they can be a great deal. In a hot market, not so much, because the bank will wait with 72 hours irrevocable, and they'll wait till they get multiple offers. And so it doesn't play to your advantage. You can't play on emotion with the bank. And so sometimes you get not that good of a deal with the bank sale. I've often seen in my market that the bank sales aren't that great of a deal. Creighton says, hi Mike, I appreciate what you're doing here. Your channel is a real wealth of information. Thank you, appreciate that so much. That means a lot. Sarah says, speaking of Airbnb, what do you think the demand and need will be post-COVID? Thoughts on rental, tenancy, vacancy? So vacancy is going to be higher than it was before, especially with Airbnb. We're seeing already a huge pullback from people afraid to travel, et cetera, and so forth. But I don't think the industry is dead. I think you just have to we have to change how we operate. For instance, we might have more vacancy now, and we may have to charge a little bit less to get stays, and maybe we'll pivot. We might pivot and we might have people jump in and say, look, I want to do minimum 1 month stays on all my Airbnbs. And now you get month stays at a time. You discount that, but you have less headaches. Wow, just got a banana. If I was vegan, I'd be all over that. $1.49 from Austin. Thank you, Austin. Hope you're doing well. Did Austin ask the question? I don't know if I saw it pop up here. I don't see it here, but if I missed it, jump in the comments, because Super Chat gets you an automatic answer on your question. That's the rule. You jump the line. Speaking of Airbnb, what do you think the demand? We did that question. Next question, Mike, thank you for all the information that your family provided. Have fun with your family tonight. Really appreciate your insights. Thanks, everyone. We're at the hour mark, so I got to wrap it up in about 3 minutes. So let's do the lightning round. You're so right about screening tenants properly. I've been keeping these debates with some family members for some time. They don't listen to me, and one of my cousins had a very difficult time removing a horrible tenant. Yes, it can be very terrible and very tough. Where do I look for investment location and property management? Any books? Biggerpockets.com is one of my favorite resources. Networking is another great one. As someone who lives in Edmonton, Alberta, $200K for a house seems like a dream. Yes, you may have to look a little further in Edmonton to find that. It might be a really rundown piece of junk. The average house price in London is near $400,000, just to put it in perspective. Do you own any REITs in your portfolio? No, I do not. I have a personal real estate portfolio that is, I'm actually too heavy in real estate, to be honest. So no, I don't. And I can deliver better returns for myself than a REIT can through leverage, through active management and active sources of deals. The issue is not about the extra rent differential on Airbnb differential on an air conditioner unit, but rather the monthly electricity cost for the tenant. Example, swimming pool, luxury for many, water bills. Brent, good point. Yeah, there's definitely electrical costs. You could find an all-inclusive that had central air. There's a lot of them here in London. We don't, like if you're in a duplex and it has 1 meter, they have no choice but to do all-inclusive in most cases. And a lot of those properties have central air. I have properties that have central air the tenants can go unlimited on because it isn't separately metered, and so I can't track that, and it services all the units with central air. So there are ways to find it for the same rent cost. Just look for that. The pool thing, yeah, I mean, the only way would be renting in a place that had a communal pool, in which case it would cost you almost nothing to have access to that pool. You could rent an apartment, a 2-bedroom apartment, or something that in a place that had access to a pool complex, or a complex with a pool. So there are ways always to find. People shut their mind down and say, hey, it's impossible for me to find this. But it's like, hey, why don't we just open our eyes up and say, okay, I can't afford to fill up a pool and pay for the usage of it, but I could get access to a pool by renting in a place where that was covered in my overall condo fee or something. Hey Mike, what time would be a good time to buy a house, during or after COVID? First time home buyer here. I don't know, I think that buying during COVID was smart. I think that buying post-COVID, after we see the cool down, there's gonna be a rise and then a fall, I think. It's gonna be like a honeymoon period where all the money's, like there's just money free flowing, everyone's still on EI till September. People are getting, instead of 55% EI, they're getting 75% of EI, they're getting all this stimulus money. So money is just flowing right now. But when the tap turns off, that's when the music stops playing and you gotta find a chair quick. So I think there's gonna be a honeymoon period for real estate where I wouldn't wanna buy. So I'm not actively looking unless I see a really good deal. And I think pre-COVID, obviously not a good time to buy. But hindsight's 2020. At what point do you think it would make sense to take advantage of the 5% down CMHC fee? Never. Almost never. If you can find the other 15% down payment from a loan shark, it's probably cheaper than the CMHC fee. Facts. Look into it. Watch my videos on that. Mark talks about the dead cat balance, and I agree. I think that's a likely scenario in the stock market. Do you think it is better to pay down your personal house's mortgage first and then buy your first rental property? Armin, no. I think it is way better to not pay down your house, to refinance your house and buy rental properties. If you pay down your mortgage on your house, you're guaranteeing yourself the rate of return of your mortgage interest rate. So if your mortgage interest rate is 3%, or in my case, like my personal house mortgage is 1.34%. I have a 1.34% variable 5-year mortgage on my house right now. If I pay down my mortgage, I'm getting myself a guaranteed 1.34%. I can go open a savings account and get 2% right now. That means it's better to put money in a savings account than pay down my mortgage. Like, there's zero incentive for me to pay down my mortgage, period. Every dollar I put into my mortgage saves me 1.34%. I get a guaranteed shit return, 1.34%. Sorry, my French. Pardon that. But do not pay down your mortgage. Unless it's like a high interest mortgage, it makes no sense to lock in a 3% or a 2% rate of return. That's a terrible return on your money. You go buy a rental property and your down payment should be producing you like a 20, 30, 40% return. Cash on cash, 20% is like the golden standard. So if I can get 20% cash on cash without appreciation, and there will be appreciation, but without appreciation, 20%, why would I choose to invest in my paying off my mortgage at 3% when I can make 20% and have surplus cash coming in? So I think it's a way better scenario to not pay down the house. Yeah, the math doesn't support ARMA on that at all. So I disagree entirely with Brent on that comment. He said, yes, you should pay off your mortgage. Do not pay off your mortgage. That's a terrible idea. Like literally just keep it in cash in a savings account before you do that. Let's think that through. If they ever tried to pull your mortgage and you could pay your mortgage every month with money in your savings account, you would never lose your house anyway. So it makes no sense to pay down your mortgage ever. Is it true banks give people 3 times annual income for a mortgage? Ivy, it depends on a lot of factors. A lot more than just that goes into the equation. But yeah, a general rule of thumb is 3 to 4 times your income, and rental income helps you qualify for more. So if you have surplus rental income, your affordability goes up and you can actually buy more properties. So that's something to think about too. Trying to go fast here, guys. From a no debt foundation, you can manage risk for the long term. I think there's a lot better ways to manage risk. For instance, having cash in an investment account is much better than having no cash and your mortgage paid down a little more. Yeah, so don't listen to his advice in that one regard. Gary says, Mike, I applied for the mortgage with a bank and put 20% down. They said because you're putting more down with no CMHC, they asked for a 2.64% interest rate than the initial 2.34. You think that's fair, please? So Gary, a lot of lenders in the last 6 months started offering bigger discounts for CMHC insured mortgages. Why do they do that? Because if you default, CMHC will step in and guarantee the bank their money. That's why they're offering you a lower interest rate if you have CMHC financing. It is a piece that can play into the puzzle. In the more recent months, I was talking about on one of my streams how it could make sense to do the 5% down deal. It's one of those extreme circumstances where, and by the way, just find a bank who has a lower differential between the insured mortgages and the uninsured mortgage rates, because you could probably just find a better differential than that example you've given. But if that was the only example you could qualify for, it might make sense to take the CMHC mortgage. If you run your numbers, the fees could be cheaper than borrowing the money from elsewhere. If you have access to if you had the 20% down though, the numbers support putting the 20% down regardless. The CMHC fee will kill you. Yeah. But typically you're right, Brent, it would be the more you put down, the less the risk. But in this case, when CMHC provides insurance on, you put 5% down and you pay a huge fee to CMHC, typically they'll take your whole 5% down payment as their fee. It's like a 4% fee. So pretty much your whole 5% down payment is gone. Like you put on a $500,000 house, you might put $25,000 down. That's gone in a $25,000 fee to CMHC. But then they're going to guarantee to the lender that if you default, that they're going to make it whole with the lender. So the lender feels like there's lower risk associated with that, and rightfully so. You need it, bro. Wow. He sends me a peach this time. A banana and a peach. Only one peach? I'm surprised there's not 2 peaches. Inside joke. You need it, bro. That's just too good. Thank you for that, Austin. Austin was, go check Austin out. Go give him an Instagram follow for that, guys. Next question. Come to the Caribbean. Loads of free bananas, all organic, plus other free herbs and fruits. Not a huge fan of the Caribbean for living there, but I'd be down to vacation. Next question. Hi, Mike. What do you think about Meet Kevin recommending to buy a 2-bed, 2-bath condo as a first property? Maybe. I certainly wouldn't recommend buying a condo in general. The condo fees tend to eat most of your cash flow. Most 2-bed, 2-baths I see don't cash flow well, but maybe there's a wedge opportunity or something that's going on that's backing his decision. So I won't necessarily say without context he's wrong. He could be right. If there's no cash flow, that makes me feel nervous unless it's a flip. So I'm not a big fan of condos in my market. It doesn't make a lot of sense from a cash flow perspective. Most 2-bed, 2-bath condos in my area cash flow like $100 a month, which is a terrible investment when you can get $1,000 a month with other properties in the city. So that's just my 2 cents. Mike, sometimes just briefly listen to you as you talk glowing about real estate in London, Ontario. You make me think of returning to Canada, perhaps not in person, but money-wise. By the way, government securities in the Caribbean yield 5% and up per year, tax-free and no expenses or fees. Yeah, actually, believe it or not, in like places like Costa Rica, the Scotiabank in Costa Rica, I hear there's like a 10% interest paid on savings account balances in USD. So you take USD money and you put it in a bank account at Scotiabank in Costa Rica, and they pay 10% on your savings account because they take your money out and they lend it out at 12%, because mortgages are so expensive in developing nations like Costa Rica. So I know people that go down there and they just park their money in a savings account down there, and it makes them 1% a month. And like, I guess the bank could fail down there, and that's the higher risk. And Costa Rica could fail down there. Like, the government is a higher risk than, say, Canada, the United States. And so they pay a way higher return to attract capital. And so that's something to think about there. You could just put it in the bank in places like Costa Rica and get a great return on your money. Sam Kuti says, what's up? What's up, guys? Good to see you all on. We've been on for over 70, almost 71 minutes. So thank you all so much. I have to go spend time with my daughter now. Thank you all so much for watching. If you're watching the replay, I look forward to seeing you in the comments, and you better smash that like button. As always, the secret to unlocking a wealthier you, 3 levers. I'm gonna stand on a podium and say this every single time. Spend less, earn more, and maximize returns on the difference. Thank you everyone so much for watching, and I'll see you next week.